In the early stage, you're taking uncorrelated business risk. And in the late stage, you're taking 100% correlated valuation risk. If the growth is there for one more year, it looks cheap.
Now, this week, we have a lot to cover. Anthropic's $10 billion fundraise, xAI raising $20 billion, Andreessen Horowitz raising $15 billion.
I would be nervous if I was a $27 billion precursor investor, but they've created something amazing.
If you're OpenAI, are you not slightly nervous? You're being eaten away by Anthropic. And then on the consumer side, you've got Gemini outperforming.
Well, luckily you're a nonprofit, so whoever wins is great for the global economy, right? You don't have to worry about it as a nonprofit. It's all for the greater good, where we have ascribed the odds of a downturn to less than zero. I think OpenAI has existential risk. It is a bet that the best of times lasts at least a decade. It's pretty interesting that Andreessen not only raised the most capital, but on a 2x2, I think has the strongest founder brand.
You can be promiscuous at the A if you have enough late stage stuff to cover it up.
Ready to go? Boys, we have a big lineup today. We're going to start with two monster rounds. It seems the only thing anyone's talking about right now is Anthropic. Anthropic raising $10 billion at a $350 billion price. I would love to hear your thoughts on this. Is this the last round before they go public? How do we feel about the price? Over to you.
Probably yes on the first question, because they've stated they want to, and it feels like they can. And if someone says they want to do something and it feels like, and that thing is doable, then logically it should get done. So yeah, I think it probably will be the last one before the IPO. And how do you feel about the price? Look, when they raised at 160, I remember internalizing, we talked about it, and frankly, we talked about it in our partnership. You kind of go, big number, wow, that's the second or third largest private cap valuation ever. And then you look at the market traction and the revenue traction, and you go, on a revenue multiple basis, it's cheaper than some of the stuff we're doing at 200 and 100 pre. Because this is a company that's gone from, it's easy to remember the numbers for Anthropic because they very kindly did them in round, units of 10. They went from 100 million in 23 at the end of 23 run rate to $1 billion at the end of 24 run rate to allegedly about between 9 and 10 billion at the end of 25. So let's assume those numbers are roughly correct. They 10x'd 2 years in a row. I don't know, next year let's just say they only 3x. So they go to 30 billion, right? Now, a rule of thumb is, I'm going to go now from ARR and run rate at the end to GAAP revenue for the year. A rule of thumb says, take the opening ARR, the closing ARR, and calculate the average. 10 billion, 30 billion, average is 20 billion. That says they do actual GAAP revenue of 20 billion next year. So it's, 17 times NTM revenue. It's a much lower revenue multiple than Palantir. It's kind of comparable with Cloudflare, for God's sake, in the public markets. So you do that math. If the growth is there for one more year, it looks cheap. It's the old rule. It turns out you really, really can pay up for anything that goes 10x year on year. So that's the bet. And the guys who did it at 170 3 months ago are feeling pretty smart now. They're at 2x in 4 months. Calculate that IRR, Harry.
Only raising 10 billion, it's actually a sign that the unit economics are probably healthy. It's not that much. It's not that much dilution, right? So I think Anthropic's been clear that they believe that their unit economics are strong. They own not just enterprise, but they own code creation. They own application creation, right? They own building everything we have spent our lives working on. And if you're building with these tools, I know it's the trite VC thing to say, but it's hard not to believe we're in the first inning and just getting going. It's literally hard not to believe it. So how that works out on a spreadsheet to how many tokens, how many trillions of revenue is complicated, but qualitatively and subjectively, it feels like first inning.
Jason, do you think they have the enterprise market at this point?
Everything that I see at the API level, Claude has won it, and nothing is perfectly stable in AI. We should not feel that anything's perfectly stable, but the reality is so far nothing's dented that. And it's birthed Cursor and Lovable and Replit and Harvey and Lagor. These all. Even Cursor is just a derivative of it. There's other models as well, but it's tough to stop this train.
Yeah, I agree, and I think you should break the market up into I would have said 2, and as of yesterday, I'm going to say 3, and I'll tell you what I mean in a second. The enterprise market. There's the enterprise API market, which is basically selling your product to other ISVs who are building on top of it, or enterprise building on top of it. And they've been the premium product there for the enterprise for a long time. Because you're quote unquote just an API, there's always a risk that as an ISV is building on top of your product, they might try and use cheaper open source models for some of the more commodified stuff. But to the extent that you need the high end part of the product, that's been the business that Anthropic/Claude has been able to get. So further on, and that's where they started, obviously, at the API level. Now, the second thing that obviously, and one of the biggest customers for that was the coding companies like Cursor and that. So then the second thing they've done, within the last year is they've said, I don't think they said it as malevolently as this will sound, but they've like, hey, coding is probably the single largest use case for what we make. Let's build a coding product. So they have Claude Code. And that's allowed them to, quote unquote, win at I'm taking your win at the enterprise comment. Now they're winning not just by being the API, but being the app for coders. And it's not 100% win. They're kind of competing with Cursor, they're competing with GitHub, but you're grabbing more money instead of maybe being 50% of the revenue of a coder because you've got with a gross margin of 50, you're getting 100% of the revenue because you're selling the product. So that's the second category in which they're clearly, quote unquote, the winner. I mean, my sense is their enterprise share of coding revenue is plus or minus comparable to Cursor and GitHub, maybe a little lower, but growing nicely. And then the third thing is they announced the product yesterday, and caveat, I haven't been able to use it yet because I'm actually here to announce that, but it's early in the morning, my coffee hasn't kicked in. The product is basically, it's Claude for non-coders. It's the ability, it's kind of an ability, it's Claude Workspaces, I think it's called. Don't quote, I could be wrong on that. But basically the idea is if you're doing other knowledge work, other than coding, can you do it within Claude? And this is the idea that the world, I think, has been going in this direction. We talked a little bit about Manus last week, companies like that. There's a number of others. We have one, Obvious.ai, that has kind of launched a product in that space that's just starting now. But, Claude Workspace, obviously the dominant one. The idea is that if you're building PowerPoint, if you're manipulating data, if you're doing all the other knowledge work that those of us who aren't coders do, instead of bringing the AI to the Excel spreadsheet, which is what Copilot tried to do at Microsoft, you bring all these tools into the Claude space, into the workspace, and maybe be more efficient. Now, I've read some preliminary reviews. Some are like, yes, this is amazing. The people who've used it more said, yeah, it's amazing, but it's a bit janky. But the idea is there. And clearly, the reason I mention all this is the idea is the direction of travel is, hey, don't just be, quote, the chatbot for enterprise, the chat interface for enterprise like ChatGPT for research. Be the place where you do knowledge work for the other knowledge workers who aren't coders, right? At a high level, and this is a zoom out comment, but it's a scary one if you're Microsoft. It's like every single knowledge worker uses the Office suite. You get PowerPoint, you get Excel, you get Word, right? What is the AI version of the Office suite? And because that's a great it's a kick-ass product for Microsoft because every knowledge worker buys it. Can you imagine turning up for work and someone saying, we're not going to give you a spreadsheet, a word processor, or a PowerPoint product? You're like, what the fuck, right? The idea that for every knowledge worker, there can be some product like this, some bundle like this is a huge ass idea, right? And I don't think this is it yet, but the idea is clearly to the extent that you are doing knowledge work using AI, you probably will need some space to be in. And that's the game they're just joining now. Sorry, long-winded answer, but the idea is, so they're going for another slab of revenue. Sorry, Harry.
My job is to ask provocative questions. When we look at case 2 there, you mentioned kind of Cursor and the potential impact that Claude Code has on it. I speak to many CPOs as part of 20 products, and I ask them about tool usage internally. Everyone that I speak to instantly states Claude Code. And the portion of people that said Cursor has gone down dramatically in the last 3 months. Would you feel nervous if you were Cursor and a Cursor investor?
Depends on the price I got in at. I mean, I wouldn't feel nervous if I got in at, the round of 200 million pre, because it's not going away. I mean, again, there's an element of a horse race drama here. We like to get caught in you call it provocative. I might call it getting lost in the details. There's no doubt that Cursor has got 2 large competitors, both of whom can bundle with adjacencies. A, Claude Code, where they have a strategic dependency as well, and B, GitHub. So yeah, I would be nervous if I was a 27 billion Cursor investor, but they've created something amazing. And what I always say to my CEOs is the best way you know you've graduated from one league is when you start competing with people one league up. It's like, you're in Division 1 of the English Premier League, and suddenly you graduate to, the top division, where it's champions. What is it now? Premier Division, right? Yeah. I'm so old. I remember when that was Division 1. But anyway, you just get to play against different competitors. I mean, Cursor is now up against Microsoft. It's up against their own supplier, Claude. So yeah, they're playing in the big boys leagues. But are you a little scared? Yeah, but you're damn glad to be playing there, because the other 10 coding agents ain't even going to get to play.
For sure. I would listen, if I were an investor. First of all, I've given up. In the age of AI, I've given up on this nervousity of competition and disruption.
I love it.
Because what can you do? These products none of these products even worked a year ago. How nervous can you be holding a large position in a product that didn't work a year ago? You can only be so nervous or quit the game. But even little things like Anthropic cutting off xAI's access to Anthropic this week, it is easy for me to imagine the business model switches. Right now, it's great for Anthropic to get an extra $1 billion or so a year from Cursor. It's a great deal. It's free money. They repackage the product. I don't believe they have to sell it at any discount whatsoever, and they get another distribution channel. Should that change as Anthropic crosses a couple trillion and 10 trillion in revenue, it's easy to imagine, one, they could cut off access. Like, that sounds aggressive, right? Or they just might limit access to the top models. They just might limit access. They just might degrade it. So there's no reason to believe that, what's the expression, that the scorpion might not sting the who's the scorpion taken across the river?
The frog and the scorpion. It's in its nature.
Yeah, there's no reason that Anthropic just might sting Cursor just before it gets to the other side of the river. I think it would be naive to assume otherwise, right? And there's many ways that the scorpion could sting the frog. It could be the simplest way is to limit access to models. They've already done it on a limited scale with xAI and others. They could simply copy the product. I mean, how hard is it to build an IDE that's just the same as Cursor? It's really not that hard. They can build Replit and Lovable too. These are not the greatest challenges of mankind. So all of them are at risk of the scorpion stinging the frog, but I would still invest.
It is worth pointing out that when the scorpion stings the frog, the scorpion dies too, in the old Aesop's fable, and in the Crying Game, if you remember the movie. But yeah, I love
die too.
Yeah, I love it, Jason, because the first thing you said, I think, is just really so true. It's very helpful for me, because the comment on being scared, if you're going to be uncomfortable being scared, you need to just go home. I'm scared all the time, because these things change so much. I mean, I think we said this before. In SaaS land, you could compound for 7 or 8 years. Now, there's existential risk every 6 months, and if you can't live with that, you probably need to find a different job. So I think you're spot on there.
If we've got to be comfortable being scared, to what extent is Google choosing Gemini for Siri over the prior relationship with OpenAI a massive deal versus a temporary moment in time where Gemini is proving to outperform?
The big deal comments are this. One, Google and Apple obviously have a long-standing relationship where the money moves from Google to Apple for placement of search, because search monetizes with advertising, so therefore it's valuable to get real estate, right? So they have a long-standing relationship. So it kind of makes sense that you'd go with your default relationship to make it happen, right? The odd thing is, for this relationship, the money I'm not clear on the money movement, but it kind of, because there's no advertising model, maybe the odd thing is Apple might be paying Google for Gemini, I don't know, while at the same time getting paid a lot more by Google for placement on search, which is why the two products are slightly different. That could flip. If OpenAI had a model, for example, that had ads in the thing, then maybe the dynamics of the money move can flip. But yeah, if you're in the distribution business, you want to be on 1 billion phones. I mean, the proof that it's worth something is Gemini. I mean, Google pays, I used to know the number, I don't, 10 billion a year, some absurd sum of money just to show up on the phones, because it's the best distribution on the planet. So yeah, at the margin, you're sad. And that's the economics was stupid. It's not like, actually even cancel that comment, because it's not like OpenAI blinks at bad economics. I mean, those guys have, an economic indifference curve that would make your head hurt. So yeah, I think it's at the margin, you'd be bummed not to be on it.
Certainly today, Google feels like a far more stable partner than OpenAI. It's just the reality. It's not OpenAI is not the only game in town anymore for Apple. The only thing I would add, which, sometimes when I've spent time with the senior folks at Google Cloud and other parts, I realize we underestimate how mission critical privacy is in the deep enterprise. We don't talk about privacy enough. We don't talk about, and so the fact that Apple made clear that they felt this was the best solution for user privacy and that they can maintain the most data within their clouds and their systems, we can joke. We don't care about that with most of our startups. Yeah, we care about privacy. Hopefully it doesn't leak. Hopefully the agent doesn't expose your data publicly. But this is even a lot of enterprises think they worry about whether Salesforce is secure enough. They want to run their CRM on their own private clouds, on their own data. Google Cloud, it's not as big as AI, but they have a massive business running Salesforce on their own private clouds for customers who somehow worry Salesforce isn't secure enough. So when Apple says privacy is part of it, it's just a reminder to me there's another level here in the big enterprise that a lot of folks can't touch. We actually don't have those levels of security and privacy. We're not going to earn those deals because we're not that secure. We're not more secure than Salesforce. It's a high standard.
If you're OpenAI, are you not slightly nervous? You're being eaten away by Anthropic, who have headwinds behind them, seemingly like they haven't had before, and incredible model performance. And then on the consumer side, you've got Gemini outperforming, you've got Nano Banana being incredible, and the tailwind of Google and the machine behind Google. It feels like you're being eaten at every angle, combined with very high SBC and high churn, and it feels precarious.
Well, luckily you're a nonprofit, so whoever wins is great for the global economy, right? You don't have to worry about it as a nonprofit. It's all for the greater good.
You're not a nonprofit anymore. Stop. No, hang on. Stop. First of all, no, hang on. It's confusing when Harry says. First of all, just to be precise, you're not a nonprofit anymore. Your largest shareholder is a nonprofit. So to just make it even more hard, if your economic value goes down, the biggest single loser is this wonderful nonprofit called OpenAI Nonprofit, which has already made some interesting donations, which is very clever, by the way. Once you got that deal done, start dispensing some money as a charity to show it's a charity, to separate the two. So, if OpenAI's value goes down, the largest loser is a charity. The second largest loser is Microsoft will survive. And as you pointed out, the third largest loser is Meta. So it is a problem. But the core question is, precarious is a little strong one. You feel angsty and driven. I mean, that's why they're at Code Red. But to Jason's point, anyone who's not feeling nervous doesn't understand the game. So of course they're feeling nervous because, you got to play the game. But look, I saw I thought in the New York Times this morning, I could be wrong, Sebastian Maltby, who I think wrote the book on venture at one time, was kind of, I think OpenAI goes to zero. And I think that's absurd. There's huge value here. I still, we all default. They have 800 million users. They'll find a model. I mean, I think that there is a model there. They have subscriptions. They have a business. It's not going to zero. The way I keep score is not, does it go to... the way I keep score is the relative value of Anthropic to OpenAI is kind of the ratio of, let's call it management success from over the last 3 years. And the truth is it's gone from 10 or 8 to 10 plus to 1 to much more convergent. It's now only 2 to 1. So if you were in a race, the objective measure of success over the last 3 years is something like you were in the lead, 10 to 1 over the other guy. You're still in the lead, but he's now only 50% behind you and coming on fast. So are you nervous? Yeah. Are you bummed? Yeah. You're still in the lead. Don't blow it. And I think, you've got a differentiated business. I still, for all the Gemini talk, I still enjoy the ChatGPT experience more for the kind of research I do, for example, to go on this pod. So they got something amazing and compelling there. They just need to, frankly, focus, knuckle down, focus, and make it work and make it, realize its potential rather than make it work. That's a stupid statement, Rory, because it hasn't made it work.
I think there is a very simple bear case for OpenAI, though. There is a very simple bear case that it goes almost to zero, which is that shelf life of an LLM is less than 100 days. Half-life is very short. And something happens. There is a macro disruption, and OpenAI can't raise the capital it needs. All of its competitors, we just talked about how Anthropic has much superior margins. Gemini, massive cash flow. And XAI, crazy, but it'll get $1 trillion of Trump contracts. OpenAI is vulnerable to, we joke about macro disrupt. Every portfolio company that didn't hit its Q4 numbers blamed macro disruptions. But it easily could, like this we've never seen this amount of capital availability ever. And it is not hard to imagine something. We've had systemic shocks in our lifetimes. If this was 07, 08, or whenever, OpenAI could it could die in the sense that it could not evolve when its competition could.
One caveat, I understand your comment, which is why the old Bill Gates rule, and was always have 2 years of cash on the balance sheet, like OpEx cash, right? Because you're right. If that's the case, then you can't. The way you could only get into a really tough situation is if the world went to shit just when you needed to raise more money. So they're smart people. If you're running the CFO of that company, your mental rule of thumb should be raise like crazy. You've got the world's best fundraiser and never have less than 2 years cash. Because with 2 years cash, even if the world's changed, you can tweak the thing enough to converge more quickly. You just dial down your ambition and dial up your cash flow focus. And in 2 years.
But how do you do that if Gemini and Anthropic can keep going? How do you do that if your competitors can keep going through that? That's the thing. This isn't Workday spending a little bit less on making sure that the Windows 98 integration works properly. You die if you don't have the capital.
But I suppose you're right, Jess. But I rejected your first comment, which I don't believe this is the kind of user base that churns at 100 days notice. I think that there is an increasingly large degree of consumer behavior and stickiness. So yeah, can you paint a scenario?
Wait, hold on, just 1 second. Just imagine. Okay, OpenAI needs $100 billion in the next 2 to 3 years. That is more than it has spent to date. Okay, its spend is accelerating. Let's imagine it can't raise that and it's frozen in time. ChatGPT is essentially frozen in time today. Would you use ChatGPT from a year ago? Would you use Claude from a year ago? NFW, you would use these products from a year ago. There's no way you would use them in Cursor or for coding. There's no way. There's not a 1 in a million chance any developer would use a year-old model today. They were so terrible. This company would deteriorate. So it would be like Detroit, like it would still exist. Right? Or it'd be like AOL and dial-up. You'd still hear the shrieking because some people don't. Grandma doesn't know. Grandma's fine with ChatGPT from a year ago because it helps her with recipes in the kitchen, but the rest of the world's moved on to broadband.
Two comments. One is, yes, it is, by the way, it is astonishing that someone just traded AOL and it still has cash flow. That was the funnest fact of the year. Like literally last year, someone thought, wow, that thing's worth $1 billion still 20 years on.
Harry, get me on the internet.
Yeah. But I don't agree with what you're saying. I understand the point, but what you're saying, imagine a 2x2, which is, macro conditions good, macro conditions bad. And then the other side of the 2x2 is scaling laws still working, so improvement is vital versus scaling laws slow down. You're right. In a world where scaling laws are still massively working, so the next model is infinitely better than the last model, and where macro is shit, so they can't access the capital, then in that corner case scenario, then you're right. You can paint that scenario because you can always paint a bad scenario. That's what you learn. I think it's just the lower likelihood.
Let me just add one more point, and I don't want to take too much time here. Yeah. You're the boss. I think we have returned to a moment in time. It feels like late 2020, 2021, or maybe, Rory, you can pick some other times in our careers, where we have ascribed the odds of a downturn to less than zero. In venture and everything, we are raising funds, we are deploying capital, we are doing up rounds weeks after the last one, and underlying that bet essentially is a 0% chance of things not. And look, we see it in data center use, we see it in power use and water use and ramp, but and that's fine. We're not paid to mitigate downside in venture startups, but I think OpenAI has existential risk. It is a bet that the best of times lasts at least a decade. And I think you can tell me the history of downturns. They're usually shorter than we think, but 10-year cycle be a long one historically, right? 10-year with no downturn.
I do also have to say, I do think on the consumer retention element, I think you're wrong, Rory. I think people are a lot more promiscuous than we give credit.
Speak for yourself.
And I think since the latest Gemini models, I definitely am. I'm a total slut for a new model. Yeah. But since the new Gemini models came out, you've had a 22% drop in ChatGPT usage.
My son dropped it.
Okay.
Yeah, he pays for Cursor and Google's free for him. Because Google's free. He doesn't want to pay $20 a month for ChatGPT. He pays for Cursor out of his own pocket. He pays for Cursor, but he doesn't pay for ChatGPT anymore.
Summary is this, guys, and I think it's fair. Summary is this. If things go to
and
crap...
remember, invest in whatever your kids do. This is how you get into Snap and all these hot deals. You just do. So if my son's off ChatGPT, Rory, we got to short. Let's get on Kalshi and just short this baby. Come on.
Yeah. Got it. Okay.
It's to Harry's point. It is that the next generation is fickle.
Like this discussion is like, I don't know, if you ever read failure analysis of things like airplane crashes or anything like that, what you always discover is any crash is always multifactorial. There's always more than one cause. And I think what you're saying is correct. If macro goes to shit at a point in time when they don't have a ton of capital, and at that time the market for this product is still incredibly fluid at the consumer level, then if all those things happen at the same time, you have trouble. I just argued that. So it's not a stupid comment to say it can happen. It's just, concatenated probabilities that I think are fairly low. I think the much more likely is that you have to moderate your ambitions and just execute on the consumer space and make it happen and build a world-class business on that.
I mean, speaking of moderating ambitions, there's one firm that is not moderating their ambition. Our dear friends at Andreessen Horowitz, $15 billion for the new funds. I believe it was 22% of all of the dollars raised from venture in 2025 going to them with this fundraise. It's enormous. How did we react to it? And a subsequent really underlying question, do you have to go mega big platform or tiny boutique to play the game in 2026?
Listen, on the one hand, so what? We've been talking about this since this pod started, right? We've been talking about massive funds, and it's just all you have to do is just look at the Databricks and Anthropic rounds, and it's pretty easy to see why you'd want to do that playbook. I would say what Andreessen, it's pretty interesting that Andreessen not only raised the most capital, but on a 2x2, I think has the strongest founder brand. That's hard to do both. It's hard to do both, and it is evolved. And Andreessen, I mean, I've been around long enough to remember vaguely when it started, and it was cool from day one. It was cool now it wasn't what it was today, right? But I remember I had a subtenant, and Marc Andreessen came into our office to meet with them to fund them, and it was a God moment. Oh my God, Marc Andreessen, is that Marc Andreessen in the office? I mean, it sure looks like Marc Andreessen. And they have invested in that at many levels on the brand, and I don't know how they've done it in some ways, but it has, and it's gone a little bit up and down. I remember I had one founder that was pretty hot who was bummed that, he got a term sheet from Andreessen and not Sequoia, but that don't happen today. That was the 0809 version of Andreessen. That was a brief moment. And you have returns. The returns are published. The returns are top decile. So you have the biggest fund, the top decile returns or quartile, whatever, top tier, which used to be a knock. And founders love this brand. Whoever was talking about fund versus firm or platform, it's hard to do all of those at scale. Founders love it. They love it. It's defensible. So you might as well hoover up 51% of the capital and then just shut down your competitors.
Agreed. I've thought about this a lot in terms of the question you asked, and I have a lot to cover on this. Just heads up, right? And I think I'll give you the summary. They've won. And they've won really well. And the only thing that might impact them at this point is misexecution internally. But now let's unpick this. Because the first question in your little notes, you said is, can they make a 3x or a 5x on $15 billion, right? And so that's the question you asked, right? And everyone always starts with that question. Oh, there's just not enough exits to justify that, is what they say. And it's the wrong way to think about it, because I think you have to break it apart and say, first of all, is the industry at a stage now whereby that amount of capital can earn a return in total? In other words, the total capital going in. Because remember, if the total capital going in can overall earn a decent return, then it doesn't matter from the industry's perspective if that 100 billion of invested capital goes all to one firm and they invest it all, or it all goes to 100 different firms and they each invest $1 billion, right? The macro question is the overall market in equilibrium such that you can get a decent return here, right? And then the second question is, given that, like again, going back to if it is an equilibrium, can these guys, how much of that total money can they take and profitably deploy? In other words, are there diseconomies or economies of scale, and can they execute it well? And, kind of fast forward to my two comments on this is A, I think the industry is roughly in equilibrium, so they can do it. And in fact, the numbers are moving in their favor. And then second comment is, so for the argument on employing it at scale, I think it can make it. Right. So let's do the first. Yeah, they raised 15 billion, but they do 20% of the total. So it means the industry as a whole raised 75 billion. Right. And everyone goes, oh, there's not enough exits for that. Right. Well, rough and tough, 3x. The value of exits this year, which wasn't an amazing year for exits, including healthcare, by the way, was around 300 billion. So not perfect. That's not all owned by venture, but you're kind of roughly there. And the other interesting, and presumably next year, with the caliber of, if it's 300 billion this year and Anthropic alone goes public, next year is 500 billion of exits. So the industry raised under 100 billion this year. If they really raise 15 and they really are 20% of the total, that implies 75 billion of venture raised, right? It seems to me that's a kind of number that can be digested and yield a 3x return overall. So it's not like it's stupid, the amount of money. And it's actually getting better because in the last couple of years, venture has deployed a couple of $100 billion a year and only raised about $70 to $80 billion a year. Now, some of that is because some of that capital being deployed is non-traditional venture, but it's getting harder for newer funds to raise money. So if you think about it, if you move on to the second question, can they deploy 20% of venture successfully? The macro trends are moving in their favor because they're raising more money at a point in time when other people are raising less. So they're getting they're in a nice position provided they can deploy it. So I think overall the industry is getting into equilibrium. Then the second question is, how can they put it out? And they raised 20% of the money last year, right? But you've got to think of over 2 years. That's roughly, if they raise every second year, though interestingly they raise in 24 and then 25, but let's just say every 2 years. That implies it's 10% of the money on a sustaining basis. Agreed? It's like you're putting out 10% of the capital. So basically, they've got to get 10% of the exits. They got to get 10% of the Series A's, et cetera, et cetera. Now, interestingly, that work that we talked about way back last year that the partner from DST did showed like over the last decade, Andreessen did roughly 10% of all Series A's that became $5 billion outcomes. So it's kind of their market share, right? They got to get 10% of everything. They got to get 10% of the great Series A's. They got to get 10% of the great Series B's. And provided they could execute that all the way up the stack, they make it happen, right?
That's a great way to summarize it.
Yeah, and what I realized when I did that, Jason, was like, I just literally did it this morning because I'm getting ready for our offsite. So I'm looking at kind of exit data. There are two risks, and we'll talk about them in a second. But you look at it and you go, it's not crazy. And then as you say, it's in part because, you said it, is that they've done an amazing job. And I read the Packy McCormack article and all that. I think a lot of us come into this business as investors, and I think they came into it as engineers and as company builders, and they did a great job of solving the system, right? And, there's a lot of leakage along the way. One of the things that was interesting in that article is you make some mistakes. You deal with a lot of negative knocks along the way, but it doesn't matter, provided the model works overall. And again, I repeat, they got to get 10% of everything, right? Now, maybe 2 or 3 things that go wrong, right? Maybe 3. The first is, when you get bigger, if you have to do 10% of all Series A's, it just becomes a lot of deals, which means a lot of people, which means, is the marginal investor any good? Can you stay good when you have 20 people writing checks versus 10? It's just hard, right? I think you have to, that's a management problem, they're good managers. The second thing is, the funny thing is you say you got to get 10% of all exits, right? And the total exits, the total value of all private companies right now is about 3.6 trillion, which pleasingly, by the way, if you say 3x on invested capital, that's 1.2 trillion over 10 years. That kind of says it's got 100 billion a year, creating 300 billion a year of value. If you chop off just the top 3 deals, you're down well north of $1 trillion. You go down to 2.6 trillion. So the bigger the firm, the more capital you raise. The math all works, but it's very top dependent. And I taught the article back in what was very good. If you miss even, I can make my math work and not get any top 10 exits. You simply can't make this kind of math work without getting those top exits. And you don't have to get in at the A, but you don't have to do the A of SpaceX. but you better show up on the cap table before they hit total, because that's $1 trillion of value that you got to get. So that's the mission for them. And, they're doing it. And that's why
that part, to me, seems the easiest part. Rory, you simplified it in a great way, which is they need to do 10% of Series A's that matter each year. Okay. That's doable if you have a top 2 brand, I think, and you have the right team. You just meet with the job's to meet. I don't think you can do 10% of every pre-seed deal. I think even YC can't, that's a different question, right? It's doable. And then if you have one of the top 3 brands and you have a large enough team, their job is, even at Insight, I learned this from Teddy back in the day, you get fired if we don't see every deal. It's a different question of whether we win it. We get fired if we don't see every deal. If Insight can do that and Vista can do that, why can't Andreessen see every single, because they have relationships with every seed manager that matters. They're out everywhere. They're close to Gary Tan and the rest of the world. Why shouldn't you see there'll be some from left field, right? That of course, but why shouldn't you see, if your brand's strong enough, you should still see them. And then the interesting question is, why can't this was the question a couple of years ago that, I remember Andrew Bielecki from Klaviyo said, is well, why not 90% market share? Why can't Andreessen have 40, 50%? Why not? There's conflicts, of course. Let's put conflicts aside though. Why can't your math scale to 50%? If conflicts weren't an issue, why can't it scale to 50%?
It's actually an interesting question, James, because, if you think about where I started, you're right. Look, Sequoia, one of the things I always admire about Sequoia, you can tell deep in their heart they believe, even if one other venture firm has $1 billion, you're like, why are we letting them have that, right? We'd really just prefer it to be all us, right? And if every year the technology industry, entrepreneurs, gives the money, the venture guys, the chance to turn 100 billion into 300 billion. The entrepreneurs at some macro level don't care if that's done by one firm doing all of it or half of it versus 100 different firms doing it all. Right? There's no obvious economic reason. So I think the interesting
thing,
especially
if there's no downside to Andreessen, if all I get is upside, I don't get any drama if I sell my company. I don't get thrown under the bus. They do my pro ratas. The worst case is I'm treated well and I get to go to these cool events. That's the worst case. Why would I not take their money?
So you're right. And exactly right. So, because it's an interesting question. If they can do 10%, why can't they do 20? Right. And as yet, so why can't, exactly.
50.
So I think there's really 3 things that could go wrong. And it's an interesting aspect. One is that I think you should assume that when you have that, you see all the good deals at the Series A. But remember, you also see all the bad deals. So the more pickers you have to do more of the deal, the harder it gets to have all those pickers be good. Your mistake rate goes up, but you can cover for that if you do enough of the A, right? The real thing, so that's the first thing. Then the second thing is, as you get later, you just have to concentrate in the winners, right? You can be diversified as shit at the A, but going back to the comment is, if it's 3.6 trillion of total private value and the top 4 companies now, if SpaceX really was worth $1 trillion, you could argue the top 3 companies are now 1.8, right? You just got to make sure you concentrate down on those. And if you slip on missing, it just gets harder to execute. So that's the second big risk. You don't concentrate on the right thing.
You have a fund every 2 years or every year. They don't have, I think your job is to get good at concentrate. You own 50. I think Andreessen should target. Ben and Mark actually did not WhatsApp me on this, but I think your math, Rory, is so powerful to me. 10% of Series A's. Combine that with Andrew Bielecki, own 80% of your market, or you're a failure as a founder, from CEO of Klaviyo. Own 51% of venture. I believe conflicts are a super solvable problem for founders. Law firms figure it out. You just isolate it. We have 3 teams, and Andreessen becomes known as the gold standard. There are no conflicts. You can have direct competitors in Andreessen, and they have solved this. There is no leakage. They have solved this problem. And so this is a traditional VC. Even Sequoia has the issue. We don't do conflicts, right? I remember in the early days when we met, we referred some stuff, and you guys were like, no, HubSpot's our winner. We can't have any conflicts. But I think it's a solvable issue. Then you get 51% market share. Then you own, and then Sequoia and those General Catalyst guys get the scraps. If you want to build a firm and not a fund, this is what I challenge my friends to do. 51%, because your math I think you can solve all the other issues. I genuinely think you can solve them. And Andreessen hasn't had a fund below 4x gross, hasn't had a fund below 3x.
Yeah. What I like about doing this with you, Jason, is how incredibly I can go in expecting to have to make one set of comments and end up on the total opposite side. Because I was expecting to have they can't make the math work at 10%. And clearly I convinced you they can. So now you're like, fuck it, if you can do 10, why not do 50? So what causes... Well, I think that the human
factor...
factor...
to try it if you can access the capital.
Well, that's actually an interesting caveat. So I think there's 2 or 3 risks, right? One is, if you're doing Series A's, the more you do, the more people you have to have. And at some point it becomes, because the more capital you're deploying, you only have 1 or 2 moves. You either do more small deals or fewer big deals. If you're doing, instead of 20 Series A's a year, you're doing 60 Series A's a year, you need X number of GPs. I think quality goes down at scale. Let me give you proof on that. Andreessen's market share is higher than benchmarks in terms of that work that I wish Rotman, the guy from DST, did. It's higher in terms of the great Series A's, right, as a percent market share, but the hit rate is much lower. So as you get bigger, you get more done, but the quality rate goes down. And at some point, you not only do your hit rate go down, therefore you have a lot more fails. Right. So it's hard to scale. So if you scale from 5% market share to 10%, your hit rate goes down by a couple of points. If you go from 10 to 20, now you have the next 10% being written by less good investors. The pressure to do deals goes up. My guess is your hit rate goes down over time. So that's the way it happens at the Series A side. So I think there was a natural limit to this because, if you look at public investing, index investing is a scale business. Stock picking is not. Right. Now we can talk about is in the public markets, is indexing the right answer, which is why all the big money managers in the public markets are indexes. But stock picking in general, it gets hard to be smart in a room with more than 5 or 7 people in it. So I think there are inherent limits.
If you want Index and Sequoia, Index reduced the fund size that they went out and raised, $1.5 billion circa. Sequoia actually have quite constrained fund sizes. I think the seed fund is around 200 million, and they don't have billions and billions per vehicle. Do they have to embrace scale and say, fuck it, Andreessen have set a precedent, this is a money wall game?
There's no doubt that you can pursue a really great seed and Series A strategy with plus or minus 500 million, plus or minus maybe 500 to $1 billion. There's no doubt about it, right? Index can do it, Sequoia can do it, everyone can do it. The math is clear. You can have 5 partners doing deals. So maybe another way to ask the question another way is, to be successful in the Series A, do you also have to add this adjunct product called a shit ton of money for your growth stage? Right, where you use that money to do 2 things. One is to help you win Series A deals because you can say to people, not only will I do your Series A, but I have a wall of money for later. Right, that's the implied thing. And the other advantage it gives you is just you seem bigger, so you get more of everything. Right, that's the question. Yeah, benchmark have proven you don't. Right, and Andreessen have proven that it can be great. And I think the real truth is, there's multiple ways to play that Series A game. And one of the ways that wasn't true at all 15, 20 years ago, but now is clearly true, is co-attaching a big late-stage fund to your Series A fund, provided you execute on both of them well, is a way to increase your profile. It's increase your value to founders. It increases your personal net worth enormously. And provided you don't shank the late-stage part of the business, it's one way to play it, but it's not the only way.
I don't believe... No matter what VCs tell founders in their spiels and pitches, I don't believe founders highly value the fact that VCs can fund you through every stage. Every big fund tells you that. Every index, every red point, everyone comes in and says, the good news is, if we deem you worth it, we can shovel cash into you if we believe you're one of our best companies. I don't think founders go skipping down the street from South Park or Sandhill when they hear that. They just... That's not my problem, right? Getting help now and giving me the capital on the amount in terms. So I just don't think that is as defensible as winning all the A's. That is just an output of a combination of pro ratas and winning the right to do beyond your pro rata.
Put me down for a no on that, because I think there's 2 ways it helps, Jason. I don't think it's dispositive for the founder, but I think it helps at the margin because for a couple of reasons. One, it helps you tell the founder a story. Oh, look at the last 2 years. Like Lightspeed do a really good job of that. Look at, the van? Oh, look how much we owned at the exit because we were there the whole way through. And Andreessen tell that good story with Databricks. Oh, look, we're there the whole way through. And I think at the margin that helps, right? More money is better than less.
I don't think an average Series A founder is picking you because you diluted the founders of Navan to 5%. I don't think that's the most compelling story I've heard at a founder pitch.
Oh, that's
They're
harsh.
picking me because I believe Mark and Ben and team are going to help me build $100 trillion company.
The second argument, because I think the third argument is the important. I'll give you the second argument is one, you can use all the growth stage fees to fund all the platform stuff, and you can decide how much or how little you believe on that. I think the third argument is the really compelling one. Watch this. It's when I have a late stage fund, I can afford to do more. I can decide I'm not clever enough to be like Benchmark and pick just the good ones. Fuck it, I'll just do more of them, and some of them will be great. And even if I make errors at the A, I will be able to get so much money in my winners that I can cover for my mistakes. And I'm not saying that's what any of these firms are doing, but it's clear on the mat. The more scale you do, the more errors you make, right? And therefore, the only way you can make more errors is if you have a way to come back from it. And the easiest way to come back from it is just to know, if to get one good Series A, I'm willing to get 3 or 4 of them wrong, because in that good Series A, I'll do the B, C, D, and E, and the other stuff gets lost in the noise. That's actually the real power of the late stage fund. It's clean up on aisle 5. Yeah, we made some whoopsies, we made some misses, but we'll just clean it up, right? We'll go, the other 3 Series A's that went bust, cost of doing business, you're down 60 million, 20 on each. You have 20 million in the good one. You put $1 billion in and you just 2x it, you've covered your nut. That's the real strength. You can be promiscuous at the A if you have enough late stage stuff to cover it up. That's the argument. And it gets back to the core thing. I think it was inside that. I think if you approach your business as an investor, and I think benchmarks are superb, like I'm trying to pick the best. And I naturally gravitate to that. Let me try and be smart and pick the best. I think when you approach it as an engineer, I think those guys said, how do you engineer an overall system such that it works? And you say, I can take a little loss rate here, provided the overall system can cover for it. And it's just an approach.
For me, the truth is the ballooning of your growth assets means you have ever-increasing price elasticity on your early assets. And so
yes,
for
exactly.
us playing at the early game, they can just come in and bid 300 when we're bidding 150. Doesn't freaking matter, because David George is going to put in a 300 million check at 3 or 4 billion. And so the more you have here, the more elasticity you have here. And that's the real alpha that you get from this. And that was my point, which Alex Rampell said on the show that we released on Monday. Very simply, the middle is dead. Like every other asset class that matures, you see a boutique specialist and you see a very large platform play, and the middle hollows out. I mean this in the nicest and most loving way, Rory, because I think you're utterly brilliant. Are you not the middle, and how would you respond to that?
I think, first of all, in that context, you are the middle. But I think if you're going to do crudely on AUM, but I don't, and I do think that it'd be a fool. I do think there is pressure when you have firms that can raise $15 billion. And until and that definitely creates additional pressure, and you'd be a fool not to say it. I think you have to focus, because I think the word boutique doesn't just mean small. Given the stage we invest at, we can only do 20 to 30 deals per fund. We can only focus on enterprise software. We don't do consumer. We don't do crypto. You have to be good at something. At the stage we invest at, we couldn't be a $250 million quote-unquote boutique, because Series A and a Series B, you're going to have to be writing $20 to $30 million checks with 50% reserves. So what you have to do at a minimum is focus on a specific set of areas and be the best at that. Let's just examine what Andreessen does, right? Enterprise, consumer, fintech, crypto, defense, blah. If we were trying to cover all those grounds, we'd be doomed. And it's interesting today, Alex Rampell, he says that. But on the other hand, it's very noticeable that they've split the fund up into 4 funds, roughly our size, to put right at you. American Dynamism, roughly over $1 billion. Fintech and AI and apps, about $1.5 billion. Info, $1.5 billion. Because implicitly, by the way, I think it was a brilliant strategy. Very Alfred Sloan, if you read The Founding of GM. What they're doing is saying, they're recognizing you couldn't run this as a single thing, because I think you see deterioration of investment quality. And what they've done is they've given Martin his sandbox, they've given David Ilovich his sandbox, they've given Alex his sandbox, and each of those funds is a freaking boutique fund at $1 billion, just like us. So no, I don't buy that, right? A focused $1 billion fund. What they do have with the $15 billion that you don't have as a $900 million fund in the same market as their $1.5 billion AI apps fund is they have the air cover of the brand, and they have the cleanup of the $5 billion late stage fund to cover for their misses. But so, yeah, I mean, you are competing. So that's the advantage they have. But I think to just simplistically say everyone else goes away is not just, it's interesting as a comment, but it's belied by the way they've structured their business. I think, but you have to be damn good, because you have to get up every morning and say, you're competing against someone who will see almost everything, who can really lean into what they want because they have it, and they have the brand and the late stage money. So you have to get there earlier. If you wait till it's consensus or anything close to consensus, you're probably going to lose. I mean, it's the Peter Thiel question, because I always think if we look at the two biggest entrants in the last 30 years that are really since benchmark in 95, Andreessen Horowitz figured it out as founders who were engineers, and they systematized it. And I think Founders Fund, even though the name is Founders, figured it out as founders who were incredible investors and figured it out from an investor perspective. So the lens is they thought it through, whereas Andreessen Horowitz engineered and managed it through. And they both are obviously the two successful scale entrants. And I think the Peter Thiel comment is, what do you know that no one else knows? If you're doing as a quote unquote boutique or a focused firm, you have to know something and have an area that the more general funds don't have. Otherwise you're toast. Exactly. You have to see things earlier. It's hard. It turns out to be hard to make money.
Did you hear that spoiler? That was Rory saying the next fund's going to be $1.5 billion.
It's not.
Soon.
Absolutely not.
Well, look, there's I think all this, I mean, it's all true, right? Obviously, Andreessen down to YC will squeeze out a lot of players like that's, you can't argue with that. The meta question is, can you still find acorns? Can you still find diamonds in the rough? Are there any good startups that don't go through YC? Are there any of them? Are there any that Andreessen won't see the A? Anthropic is on fire, but one of the co-founders said in the very first time they tried to raise money, 22 out of 23 VCs said no. Now, almost instantly later, everyone put money in. Can you find that moment in time? If the markets are so efficient in venture, from the bottom end, from YC to South Park Commons to HFO, if those markets to Project Europe, if those have become so efficient in discovery, that the only thing left is inception. And there are a lot of VCs that have been doing this a long time that think the only thing left is inception investing. Right, because you can't compete with YC and Project Europe and HFO and South Park Commons because they've all locked up the market. So inceptions and maybe there'll be a new fund pre-EF that locks up the pre-inception market. Like we'll go to middle school or grammar school.
Yeah, that feels like the Matrix.
There is truth to that. And is there still just can you find? Here's my way of thinking about venture. This is the only thing. Otherwise, I would quit. Right, I would retire. Can you still find a $10 billion gem outside of the boundaries of this system or not? This is the meta question. If you cannot find a $10 billion gem, then this is all a game or fees or riding the downturn of industry. If it is still possible, and your fund or firm, that differentiation between fund and firm, can actually still find one of those outside of the boundaries of this system, then you can make an insane amount of money. But if not, it's all performative. It's all little checks. It's all 25K checks into hot YC companies, and it's all a lifestyle joke on Twitter. That's the question. Can you and will this market, as it matures, and it is goodness gracious matured a lot in the last couple of years, will it ruthlessly create discovery for all asset classes to inception? It's certainly all down the path to doing that, right? Here's the question to Gary Tan and friends. Can you find a great startup that won't go through YC and friends? Can you even find one anymore?
But I think just to posit it in two ways. There's two founders. There's the ones who are young and want YC, and then there's the serial entrepreneurs who want money and a good price and people who won't get in your way. Which is Andreessen, Naveen Rao, Databricks. Yeah,
why not go to Andreessen for that?
Multiple rounds before anything came public, all swallowed by Sequoia and Andreessen. So the question, just to add your addition, is can you find any founders that don't go through either YC or Sequoia and Andreessen with big money very early behind the scenes because they're in those insider networks? I don't know. I got in trouble last week because I tweeted the worst place to be investing is Series A. You either need to be pre-seed or pre-IPO today to make money.
There is one segment that will always exist in venture, I think, for what it's worth. When I look back, this is where I've done a lot of investments accidentally. We used to call it a second seed. You can call it whatever. When there's a glitch in the matrix, when they stumble a bit, or when no one sees the reacceleration. It's hard, right? But there are moments in time where someone is the hottest company at YC. It has a couple great months. It reboots, and all of a sudden it reaccelerates. 6 months, 12 months down the road. I just invested in one but because of Anthropic and friends, reaccelerated 2 years after YC. It can happen. And that is a niche, but it's a narrow. I mean, it happens all the time, right? But it's a narrow one still. That's
a hard investing ground. Like, recognize, I credit you and you're brilliant at it, Jason. But doing the glitch in the matrix, I see what others don't. That's tough.
Yeah, Owner was a glitch in the matrix when Redpoint didn't see it, and I did the seed, and then they came in and put it every single round since. There's a lot of glitches in the matrix. They happen because the progress is not linear in the early days, right? But if progress is linear, man, I don't think there's any hope for boutiques and buddies.
It's not, but it almost is today, and that's kind of the weird thing with AI companies.
It is almost.
You know, guys, comments here, right? First of all, a lot of that is true. Yeah, and just to cite some numbers, your Y Combinator, I think roughly 20-something% of unicorns have gone through Y Combinator, 80 haven't. And then, is it all going to be done by, quote unquote, the good investors? We track this by round. I mean, typically, taking 10 names as being, impressive, hard to beat, as I'd call them, right? Where you kind of go, if I'm up against Mark Andreessen, I might lose, right? We have a mental list of, X hard to beats. And, at the A, it's 40-50% of total deals. The interesting, it climbs steadily. And by the C, it's about 80%. In other words, let's call it the Rory hard to beat mental list. By the time you get to the C, 80% of the time, they have one of those names in the cap table. So the market is pretty efficient, right? As yet, as you pointed out, venture does a stunning job of missing the turn. I mean, if you take the 2 or 3 big turns of the last 2 decades, I mean, Salesforce struggled to get a dime from venture and didn't. And Anthropic and OpenAI, with the amazing exception of, KV, Khosla, didn't get venture either. I mean, the first venture round at OpenAI was 23 billion pre with Thrive, and the first venture round at Anthropic was 4 billion pre with Spark and Menlo. Right? So we're sitting here saying we have structurally solved all our problems. We're amazing. We got all this coverage, but in the end, turns out picking matters, and it is noteworthy and interesting how many of the dominant companies, because they were unusual, struggled to get venture acceptance. So it's not just a given that if you cover enough ground, you get it, right? So, I mean, Coinbase, I think Andreessen did either the B or the C. Union Square did the A, very thematically in 2012. And I think Initialized and Y Combinator did the seed. So there is an element of picking here.
There's only an element of picking if you believe that company growth is non-linear and will continue to be. If you believe that company growth has changed to being linear and signals are clearer than they've ever been, then picking becomes less important.
Yes, if it's incredibly obvious to everyone, and then you rank, to be very direct, you're right. If it's incredibly obvious to everyone, and then you rank order on, for lack of a better word, a beauty contest basis, and if you're probably going to rank lower than some people who have $15 billion and the guy who invented the browser. Oh well, if that's the way to, and you're right, Howard, there is a little bit now. It does feel a time when it's quote unquote very obvious, and generally my observation is, be very nervous when you think everything's going to work, just as a comment, because that's usually when you're.
I just look at the best in Europe, which is Lovable, 11 Labs, and Legora. I think you'll probably say it's the 3 kind of breakouts right now, and the growth has been entirely linear. There's been no faltering in execution or growth, and that is different to years gone by.
Which actually will segue nicely to. Remember, I said there's one other risk here. Right, about all these strategies, let's call it the strategies that involve excellent early stage investing as part of your overall strategy, but then a huge number, maybe 4 or 5x that number of dollars going into the growth rounds. Right, the risk in that strategy is that even if the execution is good, the pricing bet is still the remaining as yet unresolved question here. Right, in the sense of, my comment is, when everything becomes obvious in terms of market and business opportunity, valuation expands to fill the gap, to fill the vacuum. Put it another way, when it's obvious, people pay up because the only risk left to take is valuation risk. So brutally, even though, yes, the best firms win the beauty contest, but they win it at the top price. You don't get a mega discount. No one's giving Lovable is not saying I'll take $6 billion when I could get $8 billion from someone else. Yeah, the best firm might win the round, but they pay the market price. So the remaining embedded risk here is in all this sentence is that all these late stage valuations at 20 and 30 times and the growth persists. And if I was to pick if you do the post-mortem 3 or 4 years from now, if many of these assumptions would be wrong, right? And I'm not saying it's going to happen. I'm simply saying, what would that look like? You said to yourself, all these growth rates attenuate just a little bit and multiples come down a lot. And you're just in a different place. I'm going to pick on my view, one of the best companies out there, Databricks. It's doing $4.5 billion, $5 billion, right? It's valued, it's got a growth rate of 40% plus. It's cash flow positive. It's a superb company. It's one of the top 4 companies out there. What's the current value at $100 billion? It's 25-ish revenues, right? If growth slowed to just 20%, across the last 2 decades, 20% growth companies with cash flow positive trade around 6 times. 6 5s are 30. So they grow 20, but 6 6s are 36. Yeah, all the math here is predicated on these kind of valuations. And if the growth stays, I think the valuations stay. If the growth slows down even slightly, then you have a dislocation to the downside. And I think then some of those strategies could feel a little painful because you're taking this utterly correlated. What I say to people is, in the early stage, you're taking uncorrelated business risk. And in the late stage, you're taking 100% correlated valuation risk. And when it goes wrong, it's going to go wrong for all of them, right? And that's the embedded assumption that you're assuming will just be fine, Harry. Yes, it's clear, obvious, and linear. But if it's not, because it's been so clear and obvious and linear for 3 years, everyone's leaned in so far that if it dislocates even slightly, the pain impact will be magnified. And to me, that's the...
You want to hear a small, fun example? If you talked about the best ones in Europe are Legora, 11 Labs, and Lovable, right? So I started using 11 Labs for real this week. So I vibe coded my favorite thing today. It's a game for founders. It's called Founderscape.ai. Try it.
I love it.
Like 200 hours into this. Founderscape.ai. It does everything from picking your accelerator. You can join YC. You have batchmates. You struggle, you build the team, you go public. Okay. It simulates everything. Fundraising. Let me know if you want 20 VC and scale in it as funds you can raise for it. It simulates the whole thing. Like a couple hundred folks have played it. It is kind of addictive. I can tell you why. Okay. So this week I wanted to go to the next level. So your CTO joins you together and I added 11 labs and your CTO talks to you the whole game, right? Like, the team's struggling, get your NRR up, do this with your product. And I added 11 labs and it's awesome. Your CTO talks to you the whole game. Okay. It's so effing good. It's a 99 out of 100 product. And I burned through $30 in credits with just a couple people in 3 days. Okay. So imagine thousands of people are playing this game. Okay. I don't have those resources. So my point is 11 labs ended last year. They just said it. Madi is such a great CEO on so many levels, right? So charismatic, so good. 330 million in revenue from nothing, right? But if for my game, if I could do something a 10th the price or a 50th the price that was close to as good, I would have to switch. Like I burned through $30 of credits on 11 labs in 48 hours with 20 players, 30 players. I can't, like, how does it help? Rory's so good at math. Imagine I have 10,000 people playing this game for hours on end. I need a lot of fees to support that, right?
Everyone watching this, let's make Jason have a massive 11 labs.
Yes,
bill.
let's
Founderscape.ai. And the fees do come down at scale in all fairness, right? But my point is, it both shows why these companies are so explosive, right? And also why they could be fragile. Like it is hard to predict, right?
Jason, would you invest in 11 labs at $11 billion?
I would listen. I mean, I wouldn't. I would not.
You would not
at 11 billion. No,
they've gone to 330 in 2
I know.
years.
And listen, I'm not a late stage investor. I'm not Andreessen. I don't have the funds. Would I invest in the CEO? Absolutely.
If
right?
you were an Andreessen, would you invest?
I would. Madi's the kind of guy like I would just want to bet on no matter what. Right? Even if the ship went down, like I would bet on him. Okay. So if that's all that matters, if price doesn't matter, if market dynamics don't matter, I'm in. Like I would have loved to invest in any round just to be on the journey together. But 11 billion, I'm not smart enough to take because I already want to substitute out. In less than 1 week. Even I don't even care, Harry, for the most part. I don't care what my Replit bill is. I don't even look, and I spend a lot on Replit. But I was already like, maybe I need to find maybe I need to try the cheaper ones in my first week. That's why I wouldn't invest in 11 billion, right? Without more work, because I think there's an underlying fragility to it. And I think that's why Mati's such a good CEO, because he knows this. He knows there's risk, and he's going 1,000 miles an hour to destroy the competition and to not be a replaceable product in 24 months.
Jason, I'm pushing you. Is there a 3 to 5x on 11 Labs from 11 billion?
Yes, if the whole world uses voice the way all the VCs talk about it, and they can maintain some of their unit economics, of course there is, because 11 Labs what people don't get is 11 Labs lets you have conversations like we're having with AIs. Like that is a massive accomplishment. And anyone that wants to build an app that lets you talk to a restaurant or talk to a game, and it's brilliant. The API is beautiful. I implemented it literally in 90 seconds. It's such an elegant product. If you believe in voice for AI, which at least all VCs do, of course you can make the math work. It's 330 million in 1 year. So what's 100 times that? A lot, right? We've only scratched the surface, but I do worry. Like, I think this will be the year. It'll probably be the back half of the year where we have to take substitution risks seriously in AI. This is the first time I've done it. And we talked about these risks before, but they haven't impacted us as investors, substitution risks. But at some point, we're not going to want to pay all of these AI fees. I can give you another example on top of each other. Right? I'll give you another example. So the other thing I added to Founderscape, Replit includes free single sign-on, free login. Okay, it works. It works in one click. So does Lovable. So does everybody else. But they all are not as slick as using a native Google product. So I went to buy Clerk. Clerk and WorkOS are two of the hot products out there that use it. Like, WorkOS was out in the desert for years and blew up this year like there was nobody's Sunday, because it just works for vibe coding especially. And I did the Clerk, and it's pretty good. And it's $30 a month. And was that a lot of money for a product that 100 engineers probably built for a decade? No. But Replit's only $30 a month. So I was like, should I use the native one? And when Replit launches a product as good as Cursor or WorkOS, I'll immediately delete it. I will immediately delete it, right, as these platforms expand. So my only point between 11 Labs and WorkOS and SSO and Clerk is that we just haven't had to deal with any, like Legora, Harvey, there's no risk we're going to substitute them for a cheaper product, or 11 Labs, or even Claude Code, no risk. Cursor, we haven't had to deal with I think as we go on this year, this will be a stress in the system. We will genuinely, Mark Benioff will actually be right. We will rotate out for cost.
I think you will. I mean, I think you see some of that, though. It's funny because, circling back to 11 Labs, we'd looked at another company, Funstone. We looked at another company in the kind of voice space 5 or 6 years ago, because way back in the day, we were investors in Nuance in the late 90s. So we'd made money in speech one. Yeah, I know, Harry. I like to occasionally remind you of things that were around before you were born. And then we looked at that, and we did a bunch of reference calls, and all their customers, especially the bigger ones who were spending $2 or $3 million on this other speech company, were like, we're going to swap it out. So we didn't do the deal. Right? You fast forward 5 or 6 years, they're all still on the platform. They never got around to substituting it out, right? Which is, just interesting learning. So the risk is there. At 2 million spend, I don't think people bothered. The question is, at 10 million spend, they probably would, right? And therefore, the question, going back to your 11 Labs, doing a stunning company, so bummed, Andreessen, I wish we'd seen it. I wish he'd been in it. I like that market a lot because we considered some of the others, and they've just killed it. But a couple of things. One is, I'm just going to try and take on the question in real time. I haven't done any preparation on this. 11 or 12 billion, you want to make it 3x, so you got to be worth 30 billion, right? 30 billion, at scale, you're going to trade at 6 or 7 times, because that's the way human life is, dude. Get over it, right? So that's 5 billion of revenue, right, in speech. And that's a lot, the Windows Office is, I used to know this 50, 60 billion, but it's a big slug of revenue, right? And if you think about that, what's been brilliant about 11 Labs that I think gives them a chance to escape, I'm going to call it the gravitational pullback of substitution, because Jason is right. If that revenue comes from Epic Games putting voice in all their games, and they're paying Epic Games $500 million, Epic Games is going to design them out, or they're going to grind them on cost, or there's going to be a competitor. They have the best product, but it's going to be a competitor. If, on the other hand, it comes from literally tens of thousands of people using voice, where no one person is spending more than 20 grand or 30 grand, or even, consumers spending $500, then you have much more ability to kind of build a defensible business. So to do the deal at 11 billion, and I haven't thought about it until literally on the fly, you have to believe in a very distributed market where there's not just high-end people. It's not just the total dollars, but are the total dollars concentrated in a small number of people where you're a white label provider, where, you do have some pricing pressure, or are there lots and lots of people with voice? There might be. It's not crazy, to be clear, because they've proven. The exciting thing about the $330 billion of revenue, they've already proven large numbers of adopters, not small numbers of super customers. So it's kind of like you're allowed to assert something exists if you've proven it already exists by doing it. So basically, you got to just believe that trend continues. So it's not crazy, but it's a lot of annual spend you have to believe in, 3-5 years from now. I don't know. But it's a lot of momentum that you got to love.
I just think nuance was a while ago. Literally, 11 Labs is the best API. 11 Labs is the best. I mean, there's a lot of good ones out there today. It's the best API I've worked with. Okay, without question, the best API. The fact that I could implement 11 Labs myself, not a developer, in less than 5 minutes, maybe even 3 minutes, says to me and Repli might be able to add another vendor. Even split it 50. If I could do it in 5 minutes, right? I just asked Replit, at the current usage of my game, it's $1,320 a month that I would be paying to 11 Labs. That's not nothing at this scale, right?
But you made the interesting assumption that I actually thought you were going to say the exact opposite, because you said how easy it was to adopt. And you're right. If the other product has just the same ease of adoption and quality, then yes, it's easy to swap between them. But maybe you picked 11 Labs precisely because it was the only one that had the easy to adopt. This is the advantage of great product. If it's easy to adopt, then the other guys have shit to adopt.
That's why I did $330 million in a year. It's the best product. It's great. It's just, it may be fragile.
Yeah, what you're saying, and I think it's a good point. What you're saying, how far can you get on absolutely the best product and absolutely the most ease of adoption? I mean, Stripe would say a pretty long way. I mean, they got to 5 billion on that, right? And yeah, I mean, that's the question. I worry less, going back to your early point on gross margins, the cost to them. I mean, I do think a lot of these non-gross margin positive things, the good thing is they're all digital products, so time will take care of a lot of that. And cheaper compute.
The final element I do want to discuss, and Rory, you can bounce when you have to, because I know that you've got to run to your offsite. But it is all over Twitter, and I don't want us to move into politics, so I want us to stay on startups around this. So I'm going to deliberately point this to our industry. But we've seen, obviously, the wealth tax being implemented. Bryn joins Page in leaving California. Chamath,
you mean the entrepreneur's tax, not the wealth tax, the entrepreneur's tax.
Sorry, the entrepreneur's tax.
Yeah, just so we take politics out of it, the entrepreneur's tax.
We've seen Chamath say that now $1 trillion, I think it was reported 700 billion of 2 trillion now is gone already. How does this impact very specifically our industry, and how significant is this actually?
I actually meant to read the text, and I didn't get around to it yesterday, but I would make 2 comments. One is all wealth taxes underperform what the people project they'll raise, because it tends to be very mobile, and it's very hard to tax that, and people can move. So Norway, France, a bunch of people have introduced them. They invariably unwind them because you get much less than you think. That's the first comment. And then the second specific comment, where I've read it, but I haven't read the core text, is one of the weird things about this tax is they estimate your ownership based on your voting control. And what that means is, because a lot of these founders have these super voting shares, and I would say that's something I didn't agree with 10 years ago, and I've changed my mind totally. I think it's good in the public markets that founders have voting control. They're getting assessed as if they own more than they do. So instead of being 5% of what they actually have, it's 5% of your voting control. And if you've got 10x votes, that's now 50% of your actual money. So are you going to sit in California, if you're worth $2 billion, and say to yourself, I'm going to give $1 billion for the privilege of living here? I don't think so. You're going to leave. So I think going to be fairly pernicious to what we're doing here. And look, I think invariably it's unsympathetic. The sight of rich people leaving a state just because they don't want to pay more money at a time if people feel strapped, and it's inherently an unsympathetic thing, right? And it's easy if you're the rank and file to say screw those guys, they should pony up. But I think this is in the category of dumb ideas who, in trying to overreach, will end up getting less. And I think especially in taxation, the way you should approach it is not ideological, oh, we'll make them pay. It's much more, how can I cost efficiently milk this cow? Right? And I think this is going to be inefficient because I think, the super rich will leave.
I think it's much more clever and worse than it looks. It's much worse than it looks because you have to read what's happening. This is a Trojan horse. This is not about a one-time 5% wealth tax. The goal of the proponents of this bill, everything that has been put behind it, this coalition, which has already passed similar propositions in the past, Prop 55 and others, is that this will then transition to an annual tax. Of course it will. You cannot solve an annual healthcare gap with a one-time tax. It sounds good. So first they need to get through the issues here and pass it once. And then the goal is it's 1% or more forever. Then the goal, it has already been written, this has already been attempted to be passed 3 times. And then the goal is to lower it in phases to 50 million and 25 million threshold. That if you have 25 million of paper wealth based on the last round price of your startup, 50 to 25 million, you will pay a 1% wealth tax. That is the end goal. This is just stage 1 of the ultimate plan. As bad as it is with paid, it's already going to fail. If the only goal was economic, it's not going to work, right? Because we've already had 4 leading billionaires leave. But the goal is this becomes an annual wealth tax on 25 to 50 million of paper net worth. And so I say this will end up being leave for the Series B, leave before the Series B, because if I'm the founder of GC.ai or 11 Labs and I'm doing a Series B at 500, I'm going to pay the wealth tax right now as the goal it is to implement it. I'm going to pay it. And you can say, well, Gavin Newsom says it won't happen but no, like the voters in California are going to vote all this stuff in. And so what I think happens, if you just want to know what I think, because I think this is, it's much deeper than it looks. And so it's not just people feel bad for billionaires. Okay. Very few people actually feel bad for billionaires. The goal is to hit folks with paper wealth of 25 million. And I think if it passes and the next bill gets put up, it will likely pass. I think founders will begin to massively exit in 2027 before the next one goes up, because there's going to be a second if this passes and a third. So this is not one and done. This is just the start. It's just the start of what the coalition behind this wants to do. It's crystal clear. They've already put a bill up 3 times to lower this to 50 million. 1 billion is a retrenchment to get it done this year because they couldn't get 50 million passed, a $50 million wealth tax. It's a disaster. If this actually happens, people will finally flee.
Yes, they will. And I think the voters, I'm going to be optimistic here. I think one of 2 things happen. Sense prevails and it gets shot down. If that happens, it's already been an own goal because we've lost people who've left California in advance of this, and that's just stupid. The second thing you're right, Jason, is it gets passed. Then a bunch of people do leave because then it gets real and you start seeing other people leave. And then the voters face this other choice 2 years from now when they put up another bill to lower it a lot, which will cause even more people to leave, and they either vote for that or not. And, you can't, I don't believe you can't stop stupid, but I actually don't think the voters are stupid. I think the default is, look, I don't love the California referendum system, but
crazy propositions.
Hang on. We do, but it's worth pointing out most of the time they say no. Because I think, I don't love, the great thing about the referendum system is it's dumb as rocks. So I actually think the default California voter goes in to say no. So my guess is and maybe I'm being optimistic, my guess is in the end, this loses, right? But you sit back and you go, even trying to do it has had an economic cost, because if you have those kind of assets that you're subject to it, this is not an idea that it's not even revenue maximizing. If you were a revenue, let's just say you hated rich people, you hated them, but at the same time, you also passionately want to fund healthcare. And those 2 things, and you believe both, and you're a rational human being, when you look at a wealth tax, you say to yourself, if my goal is to fund healthcare, I don't do the wealth tax, right? Because it's actually not the rational way to get more money. There are lots of things you can do to tax people at the point of sale, et cetera, et cetera. We can talk about it if we have more time. So you're right, Jason. This is not a rational act by people trying to maximize dollars. It's a lashy outy thing. I'm very optimistic the vote will defeat it, but it'll still have had a cost. And it's kind of dumb. And on that note, I got to duck out, guys. I got to go and actually work and figure out how my poor little boutique firm can survive in this harsh and cruel world that we live in. Okay?
You go. Dude, I do just want to stay with you on this one, just because you said there are a couple of things I really want to understand, because I don't understand this, I'm sure. If it happens, Jason, how likely is this to actually happen?
So strange things have been passed. And the only thing that stops them from not getting passed is we're all kind of lazy and we all vote no in general. But you whip folks up into a frenzy. It doesn't matter what anyone in the governor or the legislature says. It only needs 50 plus one. It is direct. California, it's wonderful and terrible and crazy. It has a type of direct democracy that the rest of the country doesn't have. So you can go around everybody, get people upset about billionaires, and many people should be upset about billionaires, and you just need half and plus one and it passes. And so that is why it doesn't matter what people say or think. You just need half plus one.
Okay, it happens and it passes.
Yes.
What happens then?
Well, this is my point. And listen, I'm not a billionaire, and I'm not going to get there. I had a chance, but I won't be a billionaire. And so I don't have the same perspective as Chamath and others, but I do think everyone's mostly missing this point, which is that this is not a one-time thing. There is a group of folks behind it. I don't want to get political, but there's a group of folks behind it that have been working on this for many years. Of course they have. This doesn't come out of the blue, right? They've been trying to pass a version of this for 5 years. They finally figured out this is step one. Let's make it all about the billionaires, right? This is the easy one. It's easy to bash on the rich billionaires when we have a very billionaire time, when the wealthy are getting wealthier and jobs are also going away. So it's an easy one to win. That's why I think Rory's wrong, because everyone feels like the billionaires are getting, they were all in St. Bart's over the holidays, but our company's doing layoffs. Doesn't feel very good. So I'm going to vote to tax those guys. And if it was just one tax, then as bad as it is with Larry and Sergey and Peter Thiel leaving, it would at least be a bounded thing, right? It would be a bounded thing. But this is just phase one of the plan. Phase two is it happens every year. Of course, it's not going to happen once. This is how you put a bow tie on something to make it look good. It's just once. Of course, it's going to happen every year. And the prior versions of this bill and the one they want to keep passing has already lowered it to 50 million and then 25 million net worth. And it is on illiquid assets based on the last round in venture. So how many deals have you done, Harry, where the last round was at 250 million or more and the founders had material ownership? Like a lot in the age of AI, right? And so I do think if this goes as far as the folks that have backing it want, you could have a Detroit in the Silicon Valley. Like when it becomes a meme to do YC or to do South Park Common, but then get your money, build your team, and then leave. That could be the meme. Like, come to Dogpatch, do YC, stay a year, build up your team, and then leave. Like, it's not, is it hard to imagine that being the new SF? It's not hard to imagine. It's not that it would go away. It's just you leave after a year.
Who wins from this? In any loss, there is often a winner. Is there a state where everyone goes which wins?
The answer is the ones that almost won in 2020 and 2021. It's that simple, because there wasn't enough gravity to get people to go to Miami outside of, some hedge funds and others. And there wasn't enough gravity to go to Austin because it's really not that nice there. But obviously they will win because we already saw it happen, right? It's just the yo-yo bounced back up when AI came out, right? It wasn't worth it to be in Miami or Austin when AI came back out, right?
Jason, would you leave?
Well, listen, first of all, I'm not starting from scratch, right? So bear in mind, I think that is an important, it's crazy to me that Sergey Brin left because he's driving AI at Google based in the Bay Area, right? Larry Page, I get, and Peter Thiel is managing money. I don't know. I've thought about it every year since 2020 when it didn't matter for 2 years where you were. I thought about it. I'm on the edge. I'm not a billionaire, but the financial cost to me to remain in California is super high. Like what I pay to live here in taxes and others, it's worth it. But if I had to pay a wealth tax when it goes down to these lower thresholds every year, I would leave, of course. Now, does it matter? You could argue I've thought about it a lot. It would push me over the edge because then every year I'm paying this massive tax on top of 50% tax that I pay in California already, or 40% on long-term capital gains. It's the highest taxes in the country already. And then there's a wealth tax on top of it. Or every year I got to pay 1 to 2% of everything. Like 1 year, it's actually not like, who cares 1 year? But what if it's 10 years? Like that compounds to a lot, right? We need Rory to do the math, but that compounds to 15 to 20% of your net worth is going to be gone until it gets increased. So you got to go to Miami or Austin at some point in your career, right? So I think I would go, but what I worry more about, and I wrote this and it already had 500,000 views in a day. I worry that it just makes sense to leave after the Series B. You should just leave. And I think YC will get their 7% and the funds will still stay, but you'll just leave. You'll just leave. It's a terrible idea to leave SF in the age of AI, but I don't think it's as bad as going to Monaco or Dubai or weird stuff. Like I don't think that's the best way to build a startup from Dubai or Monaco. I'm pretty sure that's suboptimal. But we may go back to distributed teams. We did learn how to do it. It's suboptimal. We may not be all RTO. We learned a lot of skills that now we're putting on the back burner, but we know how to do these things. We know how to build distributed teams. We know how to work remotely. We know how to do these things. They're not as good. But if it becomes what we do, we will just adjust. We will adjust. It's not that big a deal. In tech, we are not dealing with a meta issue that the wealth gap's just going to spread in the age of AI. It's going to get vaster and vaster, and the social implications, and we're worried about layoffs and AI taking people's jobs, but people are, when you and I first met, Harry, $1 billion was a good exit when you and I first met. It was a great exit, right? Now 100 billion doesn't feel like that much, does it? I mean, it's crazy, but that's also 100 times more wealth for the founders. Maybe even more realistically, right? And so that is just a gap that we kind of hide from. And I brought it up on the pod. We didn't do it, but when every billionaire was in St. Bart's competing with their yachts over the holidays, man, when that gets retweeted, it's hard for not everyone to feel like they want to tax the F out of everybody. It's gross. It's gross, right? It's tacky. It's gross.
And when you think about the labor displacement, which you spoke about in terms of it really showing up in labor numbers this year, I think you have a real problem. And I think that's probably one of my biggest concerns right now, especially in the UK. You see the disparity of wealth just between London and everyone else.
It's going to grow.
It's terrifying.
But it's worse. It's actually worse than that, I think. And some of this we can't do anything about, is that I think even for B2B, grounded in what we do, I think we're going to normalize around $1 million to $2 million per employee. Okay. Replit, 200 employees at 300 million in revenue. How many does 11 Labs have? We can look it up. It's probably not that many, right? So as we are able to do startups with a fifth the headcount we used to, that's just going to, even in our little ecosystem, it's going to lead to malaise because we just don't need that many people. It's not about displacing or AI replace. We just, when we can get to 1 to 2 million in revenue per, we just don't need that many people, and it's going to create.
Juxtapose that with the amount of millionaires that are made from NVIDIA's market cap today who are employees. And does that not pose a dispersion of wealth because of the expansion of market caps?
It is somewhat dispersed. I forget. We can look it up. How many millionaires they have? 20,000 deca millionaires or something like that.
Something like that.
Yeah, and it has already perverted housing markets in the Bay Area and lots of things. But it's not happy. Okay, 1 in 3 employees at NVIDIA is now worth 20 million or more. 1 in 3. Okay. 18,000 folks at NVIDIA are worth 25 million or more. I'm in Palo Alto now. There are literally 0 houses for sale. Because it's instantly bought up, right? There's nothing, right? And so, okay, so on the one hand, you can say, great, there's 20,000 more people worth 20 million in NVIDIA, but what it also means is that there's so many types of inflation, and there's financial inflation and there's life inflation. The types of education that those folks can afford, the types of housing they can afford, the way it changes the wealth at the mall, at the Stanford Mall in Palo Alto is like nothing like just a couple of years ago. And that's going to breed a lot of contempt where, yeah, if you're one of the folks at NVIDIA and you made 20 or 30 million, you're feeling great. If you just got laid off from a SaaS company growing 15%, what are you going to do, Harry? What are you going to do when you got laid off from a previously high-flying public SaaS company growing 4%? What are you going to do who's going to hire you? I mean, the problem is nobody. And like we've got to tap into this zeitgeist and this wealth generation. But I think that I do think there is a level of social unrest that will grow over the coming years, and it's worrisome to me. And I think this bill is part of it. And I get why. I think that's why I think it's only the first one, because I think each year that goes by, people are going to be more and more angry at the AI decamillionaires and centimillionaires. They're going to get angrier. They work just as hard. And I got laid off from Zoom, and it's been 12 months. I can't find a job. I was a VP. It's not going to feel very good, is it? It's already not feeling good on LinkedIn, right? I'm already seeing folks as we record this. You know what happens in January? Everyone's saying I've moved on from my company. Those are the folks that got fired. You can see them. I've decided after 27 years at Microsoft, I've decided January 15th is my last day. No, everyone that on January that, they were moved out, and it's part of life. But what happens when the next job is impossible? I'm worried.
On that sunny disposition, dude, it's always a pleasure. I so appreciate you.